Hello everyone and welcome to Harvesting Innovation, a podcast run by Biotope. Biotope is a startup incubator program and a pre-seed investor backed by VIB, which is one of the world's premier life sciences institutes located in Flanders. Our mission at Biotope is to help startups take root. Twice a year, we organize a base camp for biotech startup founders and we offer year-round support to a selected few. Our program has one single goal in mind: to get your startup ready for the first seed investment in 12 months' time. With our podcast series, we want to dive deeper into some of the challenges that you, as an agri-food biotech startup, face. And we do so with founders, investors, and seasoned industry experts. We hope that these conversations can help and inspire anyone with an interest both in biotech and innovation. My name is Peter Cauwels. I'm the fund manager at Biotope Ventures. Today we will talk to Sophie Roelants and Ruben Schoenmaekers. Welcome, both of you.
Thanks.
Let me start by introducing Sophie. Sophie is one of the co-founders of Amphistar. Together with her colleagues, she entered the second cohort of the Biotope program. And now, 1 year later, she just closed her pre-Series A fundraising. Congratulations,
Thanks.
Sophie, and welcome. What an accomplishment. But before we dive into that, can you first introduce yourself, your company, and what's your drive in life?
Drive in life. Yeah, so my name is Sophie Roelants. Thanks for having us. Co-founder of Amphistar. At Amphistar, we develop sustainable biosurfactants, so alternatives for surfactants derived from fossil and palm oil resources. So by developing and scaling and producing these surfactants, we offer sustainable alternatives to companies that are genuinely looking to develop sustainable products. My drive in life, I would really like to contribute to having a more sustainable world and to keeping fossil resources in the floor so that we don't have these emissions anymore. But of course, then you need to develop alternatives and have technologies that can help us to keep our life standards while not further polluting the planets.
And you thought so, you're an academic by training, so you thought though by becoming a founder and an entrepreneur, you could reach your goals easier?
Yeah, so I've worked on this technology for over 10 years. I've started actually doing my PhD on the subject.
Okay.
And then continuing the work, scaling it, you get at a certain moment a feeling like, this is really something. We can really maybe make a difference with this. And that at a certain point really put the seed, of wanting to do something with the research and translating it into a business.
Great. Our second guest for today is Ruben Schoenmaekers. As a matter of fact, Ruben was the legal counsel of Amphistar in the pre-Series A fundraising that was just recently closed. Thank you, Ruben. Welcome. Great to have you on our podcast. Can you tell a little bit more about yourself, about your company? You're both a lawyer, but you're also a founder. So it's great to have your view from both perspectives. Can you introduce yourself a little bit?
Yeah, sure. Thanks, Peter, also for having me. And indeed, I know Sophie as well from the fundraising we did for the last months, and it took a while, so we will also zoom in a bit on that.
Ruben.
Yeah,
Not months,
a
year.
year. Myself, I'm a VC and an M&A lawyer. So for those who don't know, VC is venture capital and M&A is merger and acquisitions. So I've been a lawyer in that field for the last 10 years. So that also means that I went to law school. And I've been doing transactions the majority of my law life. And 2 years ago, I decided to found my own law firm, which is called MACE. And we try to be a bit different because we have made the choice to only take the side of the founder. So that's that's where we differ a bit from our competitors. It's also a bit of a bold choice because we're only starting up. But there are two main reasons for that. And the first one is it's just nicer to work for founders.
Okay, good to hear that.
And that's, I don't say that because I don't. It's different if you work for an investment manager or for private equity who has done it already 20 times that year. Your impact will be way lower than a founder who's doing his first fundraise. So that's one of the main reasons. And the second reason is also the founders are also typically in a fundraising the party that has the least knowledge on it. So that's a bit also the mission that we navigating the founders through the legal MACE.
Okay, that's very clear. Thank you. But just for to be clear, now you advised Sophie and Amphistar. Do you have a particular focus on biotech, or do you have a broader view? Do you take any tech, or do you take anything?
We have done a lot of different fields. So not only biotech, also B2B SaaS, but also a beer company we have done. Vending machines we have done. So a lot of fields. From a fundraising legal point of view, the topics you negotiate on are very, very similar. So I wouldn't say it doesn't really matter because the more experienced you are, of course, in biotech, the better lawyer you will be because there are different nuances. If you look at the B2B SaaS, it's valued different than a biotech company. So yeah, but more fields than just biotech.
Very broad view. Okay, so Ruben, let me start by asking you a little bit about the whole fundraising process. Could you share with the listeners what that entails? I mean, not a broad half an hour presentation, but just like what are the basic steps that need to be taken in the whole process? Who are the stakeholders and how long does it take? You already mentioned both that it took quite a long time, this closing, like 1 year. Is that a typical thing? So could you guide us with a few steps and a few stakeholders through this process?
Yeah. I will do my best, and Sophie, you can help me from your perspective if you can add. But it all depends. That's where I want to start with. It all depends because you will have a different funding round if you would raise 500,000 euro with 5 business angels, over 2 million with 2 professional VC funds, and it will be again different if you enter the Biotope incubator program, which might also involve financing. So I've already mentioned 3 stakeholders: business angels, professional VC funds, and incubators. What we also often see is that there is a combination between equity funding combined with debt or even with grants. So that's, for instance, also something that Sophie can acknowledge. Sometimes the certain grants are conditional on finding equity. So it's all related to each other, making it often very complex and very time intensive for young founders to find a way in closing that deal. And the time frame, that's the last thing I will tell about the process. If you would ask me how long would it take for a seed round with 5 business angels, 500,000 euro, I think somewhere between 1 and 3 months.
Okay, and not 1 year.
Exactly. If you would ask me how long does it take for a pre-Series A round of raising over more than 6 million, you will be somewhere between 8 months to a year and a half.
Okay.
So we didn't do too bad then. We're still within the spectrum.
I wanted to ask you, Sophie, about your personal experience in that whole process. So I'm also looking a bit, because you say you have stakeholders, but they're all investors. You also have stakeholders that are opposed to one another. You have the founders, you have the previous investors, you have the new investors. Maybe you have a university, you have non-dilutive partners, like funding, granting agencies or so. So how was that? How how could you keep all the balls in the air? How did that go? And
Yeah, I must say it was quite complicated. And also as a founder in biotech, it's typically new for you. You have never done this. So it's all, you are facing a big black hole, to be honest. And there, of course, having MACE, Ruben and Maxime by your side, it was an incredible help. And if not impossible for us to have done it. So that really helped us to see the road ahead, and also guiding us along the different milestones that we needed to take. Because in the beginning, for us, we really didn't know what was ahead. We really did not have an idea. So I would advise, if you enter this space, to really find good people that can support you. So I think for us, that was really something that without we couldn't have done it.
And you mean good people who support you? You mean only on the legal side? But are there, because now we have a legal advisor, but are there other parties that you should...
If you can find, of course, other entrepreneurs that have done the same, that have gone through a similar trajectory, that is also very valuable. And we were lucky to, through Biotope, actually get in touch with people like that could also help us even early on in the negotiations with these VCs, to do a bit the negotiations for us, or to help us in how do we position ourselves, because we had absolutely no clue. It was our first fundraise. It was already quite a big one, 6 million euros with 3 parties. So it's quite serious from the first go. And if you're not experienced, you're a bit, how do they say that? A victim for the cats, or I don't know how you say that.
A bird for the cat.
A bird for the cat.
Whatever, something like that. Yeah. But I can imagine that for our listeners, this must look a bit like a big black hole and very daunting and many hurdles to take. So how could they prepare for that? That would be my first question. And what didn't you prepare for? Or can't you prepare for?
So the big black hole, I think, again, we saw Ruben presenting at one of the Biotope events, and he positioned it actually quite simple. He said, remember very well, there are actually 20 points to negotiate on, more or less, where you can take about 5 positions. And that really helped me to get some view on it. Like, okay, for us, it's like Chinese. It looks like Chinese, but actually for them, it's really clear where are the points to negotiate on and which positions you can take. And also that these things are interconnected. Okay. So not focusing too much on pre-money valuation alone, because it's linked with, you can get a better condition in another part of the deal if you give a bit leverage or room on the pre-money valuation. So that was really inspiring to see and to learn how it works. But then still, it's really something still very abstract for a founder.
Let me just pick onto that, and before we go into the things you cannot prepare, because I'm interested to know what you cannot prepare for. It's always very cool to know that. But Ruben, she mentioned 5 topics. Do you still know them on top of your head?
I think the one that all founders are focusing the most on is on the valuation.
Absolutely.
They're sometimes a bit blind for all the other legal terms.
Absolutely.
But that's only one of the 20.
Indeed.
Maybe it's 25 or 18. Depends a bit. But valuation. Liquidation preference.
But can you explain that?
I can explain it,
I know you can explain it. Would you be so kind to explain it?
I will try to explain it in children language.
Yep, and Janneke language.
Or in pipi kakataal, we say in Dutch.
Okay. They might have to cut that.
But it basically means, and you have it in a very aggressive form. If you would apply a multiple on it, multiple 3 would be unseen, unacceptable. But in the least aggressive form, that would be a non-participating liquidation preference. Sounds still very mysterious what it means.
Still very mysterious.
But it basically means if an investor invests 1 million euro in your company, and at a certain point the company would be liquidated or sold, that the investor would be certain that he will receive first his 1 million back. And in certain scenarios, it doesn't play because we sell the company for a lot of money, and so it doesn't apply. But it only becomes a bit of tricky when it is not a non-participating, but something more, and the company is doing well, but not super well. And then you can enter into a scenario that the founders still have sold the company for an upside for the investors, but they do not have anything in the end. So what we try to do in those workshops, we try to scare them a little bit, so that we have their attention and that they really know that, okay, on these points I have to understand it. And the most difficulty, I think, is that you do not have a clue on what is the market practice, because that's not public. There is no database that says I can only dilute this amount. It's normal to accept the liquidation preference in this phase.
So that's a question we asked a lot, I think. Is this normal? Is this market practice? So that's also having someone...
And not only to us, also to other entrepreneurs. If you are in that space, in that network, also the people that you are surrounded with in the incubator program, they will also have been involved in deals, and they will also know.
So, but what would be the practice? Like 1x, 125, something like that?
There was a study a couple of years ago. It's a bit of a bad example, was because it was the Bank of Silicon Valley. But there they did a study independently. And I think in more than 80% of the cases, it was a non-participating one-time leak.
Okay.
But we have seen in practice that investors dare to ask for more.
Okay. So we have valuation, we have liquidation preference.
Yeah.
There's 3 more left.
Anti-dilution.
Yeah.
We managed to convince an investor to accept a 10 million pre-money valuation, but 2 years later, we have not done it super well as a founding team, and we do a down round. We raise again money at the pre-money valuation of 8 million. Bad luck for the first investor, unless they have anti-dilution protection, and that restores a bit the fact that they have subscribed to a higher price than the second investor. Again, you have that in more aggressive forms and in less aggressive forms. But typically, it's you accept or you don't accept. And if you accept, the least aggressive form, a bit lesser aggressive, the most aggressive one. On that point,
Number
four topics.
Okay.
Four positions on one topic.
Okay.
Another important one is the control of your company. For which decisions can you still take a loan? And which decisions you need a certain specific majority, including certain investors.
Okay. But all of this, of course, you can have a lot of stuff on paper, but then and many of these things are also risk management tools by investors who step into a round. But if the company doesn't do well, and you need all these clauses or all these triggers, the next investor still has all the power and can say, I only enter into a next, let's say, Series B round, when all the other clauses are taken out.
Yeah, that's also again true, Peter, that each round the game is played again.
So you can put a lot in a contract.
But
then 2 years later in the next round, you're forced to take it all out again by a new investor coming in, who has the power and a lot of money to put on the table. No.
Exactly. There is also an economic reality. If you need the money and you're with the back against the wall, but you don't want to give anything, then difficult conversation. Also, the liquidation preference and the valuation, they're also a bit linked to each other. On the one hand, you're saying, I'm fantastic, I'm valued 10 million, but on the other hand, you're saying, I'm scared of selling the company for less. So not easy to not accept
Okay. Interesting. But we had some still open question for you, Sophie. I'm really interested to know how. Okay, I can imagine that you prepared, that you were really well prepared for this. pre-Series A round. It took a long time. So you had time also to gain new knowledge and to get accustomed to new types of discussions. But what was the most difficult part? What is very difficult to prepare for? I know it's a very open question, but
Yeah, but I know my answer.
Okay.
Actually, for the first part, you said you did a lot of preparation work. I must say that most of the things you learn along the way, it's not something that you can fully prepare for or think of all the scenarios. It's something that you find out. For us, at least, it was the case. Maybe that's not the case for others, but that's really my experience. What you cannot prepare for me was the psychological impact, the emotional part. Because, yeah, it's business, it's work, but as a founder, you've been working on this for a long time. It's your passion. It's part of your life. And then these people come in they don't know you, they don't know your history, they don't know your journey, and they start making really it's business.
You
really
say these
hard
people,
positions. The
who
investors,
are you?
sorry. Actually, at a certain point, I got really angry, and the founders got really angry, which is, I think, it happens probably quite often. And the thing I learned is to try and take a distance, to step back and try to objectivize it, or how do you say that, and not put the emotion too much into it. That's actually also by someone that I met that is in the entrepreneurial space, where I was having a conversation, and she said, "Yeah, you're really you're too emotional now. You should step back." And that really resonated with me, and I took it along in the continuation of the negotiations. Tried to step back. Also, telling that to the other founders, because I was often between the investors and the other founders. To also tell them the investors have another view on the company than we have. So that was, I think, the thing I didn't expect, that it would be so psychologically hard sometimes and difficult.
And how could startups prepare for that? Is there a way to get ready to? How can you keep your cool, and can you prepare for that? Maybe also by having a diverse team, or to have different roles in the team. Somebody who takes the difficult, like good cop, bad cop discussions. I don't know how.
Yeah, it's for us. It really helped. We have a fantastic team. I can really say that, and we really could fall back onto each other. Sometimes it was way too much for one of us. Then the others could support and be there. And we really felt at certain points we really oscillated, or how do you say that? It really felt like we were all there, and when it was too much for one, the other could back it up, or how do you express
or take
that?
it over for some time.
What was the second part of your question?
I don't remember. That will be cut out, I think.
The team. So, and I now remember, and how to also prepare for that, or to be ready for that. Yeah, I think having a network of other entrepreneurs that have done it. So through Biotope, we got in contact with others, and you can also talk to these people and see what is their experience. That also really helps. If you have people up front that you know that you can reach out to, some kind of a mentor, or it doesn't need to be a mentor, but at least people that you trust and that you know that have relevant experience, that really helped me, that I can pick up the phone and can be really open and honest, and also get honest feedback.
Okay, great.
So through Biotope, actually, we really got access to such a network. So I would really promote it.
Great to hear that, Sophie. Ruben, maybe you have some comments on that, because you've seen more than one deal, of course. Is that a common denominator? The emotional part. And you, as a lawyer, do you still get emotional?
Yes.
That's why you run so much.
Because they always say that you cannot associate yourself too much with a case, but I'm always doing it. But I'm always doing it because I want to be also the best lawyer in the case, and I always negotiate as it was my own deal. That's a bit how I'm in. Would I accept this, what they are asking from us? So that I'm also comfortable in advising the founders in this is market practice. So the psychological part is very present, and not with biotech, but everywhere in fundraising. For me, it plays on two elements most, on dilution, and that's somewhere that is very sensitive. And another thing where founders are very sensitive is in what happens if one of the founders would leave, the leaver arrangements. Because we're also there, we're asking very concrete questions, something typically you haven't really thought of when you started. Is it okay that co-founder one keeps his shares if he leaves after 6 months after the fundraising? And the answer is, all VC will tell you no.
Of course.
If you don't do VC rounds, then that's fine, if you can agree to that. But in venture capital, that's not done. So explaining someone who, okay, it's your product where you've been working on for the last 10 years, and the shares that you have, they're yours. However, we can still take them away from you if X, Y, and Z happens. That's something that we really have to explain the rationale behind it. And once explained, you also typically see makes sense why.
Yes. And maybe it's, I always advise that you have to all these things, you write it down for when things go wrong. After all the contracts are signed, you put them in the closet, you return the key, and you hope that you'll never have to take it out, except for when you do the exit. And you want to see how in a successful situation, everything should proceed. But you have to be a big girl and a big boy at the moment of these negotiations and prepare for the worst. But know that afterwards you put it in a closet and you forget about it and hope that everything will go wrong. Do you agree with that as a lawyer? I'm not a lawyer, but that's a bit my point of view.
That's the idea. And if that happens, then that's the best scenario that can happen, that you do not have to look at your contracts. However, in reality, we often sometimes see that it's not always easy to commit yourself for 4 years in the future. And people are people, so stuff happens.
But then it's better that you have it, that you have written it down, and that you have a scenario that if things happen, okay, then A, B, C, and D.
Exactly,
So it's better to bite the bullet during the negotiations and prepare for the worst. And look at it from a negative point of view for a certain amount of time. Like what happens if somebody dies? What happens if somebody leaves? What happens if we go bankrupt, or if we have to raise money in a very hard down round? It's better to do it, bite the bullet, and then when things go wrong, you at least have a scenario ready. No?
Without going too far in it.
That's
also, I think, the balance.
Not
at a certain point, you also need to be. You have to have the West Flemish pragmatic.
But you're from East France.
I am, but I'm using the example. Also, something I want to say is, we have seen a business angel of West Flanders who invests more than 1 million, and he doesn't ask even for a board seat. Is it okay if I have an observer? And then second email, and if I cannot come, is it okay that my wife comes? That's it, nothing more. And then we have a professional fund that invests an amount that's maybe half of it, because they are professionals and they know the game, and they have also a commitment towards their LPs. So they cannot be like that in the deal because of their own achterban commitments. So that's also interesting to see that that depends on what's your investor. And
we were all discussing about valuations, and it's a very sensitive thing. And personally, I think it's sensitive because founders want to keep control. A valuation reflects the percentage you own in a company, and the percentage you own in a company reflects the control you have on a company. So that's how we often see that founders want to keep a majority as long as possible. I don't know what is your idea on that. how hard should you hang on to it? Because it's not a matter of greed, the valuation, but it's a matter of control. No, so how hard should you hold on to that? When do you say, okay, Sophie? When do you say, okay, I'm happy with the founders not having more than a half and giving away a lot of the control of the company?
Yeah, it's as Ruben mentioned, it's not only, of course, the shareholding, but also how your board will make decisions. So that's a point for us where we fought quite hard, where they also advised us to really stand our grounds. It also, of course, relates to the percentage you have. For us, we of course tried to keep the majority as large as possible, but as we also know that we will have a follow-up round of a much bigger amount, and we will be diluted below 50% anyways. At a certain point, we took, how should I say it? We accepted that it would not be a lot higher. Then we still have majority, but it's not like. Normally, I think in the first round you should not give away more than 30%. I think that's a bit the rule.
Would that be a rule of thumb? And what do you mean by first round? Seed round?
Seed round, yeah.
Yeah.
And then what do you mean by seed round? 1 million?
I would instead of pre-seed seed, I would just use the word equity round.
Okay.
Yeah.
You have a very good data publicly available from Carta. I don't know if you've ever heard of it, but if not, look it up.
Thank you.
I think it's a portfolio company from Sequoia, and they are sitting on data on all US startups that raised funding and has an ESOP plan. And since a couple of months, they have like very good insights. And one of the insights was how much do you dilute typically in each round? And I think the median, and because the average is not
skewed,
was 20-25% per
round.
Yeah, but irrespective of the amount you raised.
Okay.
Which makes it interesting.
Yeah.
But then again, approaching a negotiation like that is also a bit the other way, the world on his head. Because if you typically, you start from valuation, that is the money that we need. And that's how you calculate the ownership that you give away. Very difficult in early stage because there's not a lot of data. So we have to do a lot of forward looking. And there we can calculate ourselves rich or not.
Absolutely.
So that's the difficult exercise, and I think that's also the reason why incubators typically decide to choose for a fixed percentage. But that's also something that I see.
Interesting. Interesting source. And is there a difference between the US and the Europe, probably?
I think in Europe that you will give a bit more away because in the US they're generally a bit more
founder friendly,
a bit more friendly with their valuations.
Much higher valuations.
But out of my experience, I would say from 15 to 35%.
Okay.
That you give away each round.
Very valuable.
And I think the ambition of most founders is to survive a second equity round and still keep the majority. That's the ambition.
Okay.
Things are different in biotech because it's very capital intensive.
Okay, cool. One thing that we often hear from young startups is if they prepare a pitch to investors, how much should they talk about exit scenarios? And they're all, especially Flemish startups, they're a bit awkward, feeling awkward, how do I have to sell it? Can I really say that you will make 10x, that you will have a 10 times return? How should I do that? I feel uncomfortable with it. So what would be your advice? Would you say to these people okay, go for it, just give a crazy scenario like everybody expects and say that your investors will make 10 times their amount of money? Or should you be more down to earth and be a bit more realistic? Or does it depend on your personality? I always say that if you don't feel comfortable with it, you should not say it. So if you have a personality that's more modest, you should not force yourself to sell a 10x multiple to investors. But I would like to have your opinion on that. What would you advise?
Yeah, we didn't put it out that bold, but maybe we're too humble. Yeah, could be. But if it's of course always good in the space to be bold. You have to believe the sky is the limit. If not, you will not do it. It's almost the rule of the game. But to put a number for us, it's really something. Yeah, how do you calculate that? How do you predict that? You can put some numbers on it, and we also did that to do the calculations, but we never put that forward as a key selling point of our to invest in our company. It's of course part of the story, but it was not our key selling point.
But you could maybe put it differently. Do you think if you cannot present one possible future pathway of your company that makes 5x or 10x, if you don't even have a reasonable probability, like say 5%, do you still have a chance with VCs? Ruben, maybe?
I think, again, if you really look at professional investors, the whole thing that they're doing is trying to secure a return on investment for their LPs. So you have a lot of VCs, mainly international, that say we don't invest in companies that do not have the possibility to give us a less than a 10x.
Exactly, you hear that.
But recently, you also hear some other VCs. I follow quite some podcasts on VCs, and I have a couple of those insights from there, not from myself. But you have also a certain amount of VCs that focus on the 4-5x companies that are a bit less of that all or nothing game. Because if you want to really do the 10x, then you really have to burn the cash and find and grow the team and sell the products, and also find the next investor who's going to fund that track. So if you don't have that, if you invest in 10, it's maybe 9 that go bankrupt. That's the game of VC. And that one is then that unicorn, that delivery actor, that Colibra. But you could also change your strategy, I think, as a VC. And why would I not focus more on the 3, 4, 5 axis and try to build like a stable portfolio company?
So in a way, it depends a bit on your personality and the type of investors you choose as a startup company.
Yeah.
Okay, thank you. Very, very valuable. Up to now, we have been focusing a lot on fundraising per se, but of course, there's a broader market that every company operates in. It's generally known this past year that it's a very tight funding market for biotech companies, but probably for most tech companies in general. Do you see an end at the light of the tunnel? Do you see any progress there? I mean, do you agree with it that it has been a tight market in the last year, and how could that evolve? Do you?
I think there was like a valuation bubble a couple of years ago. I think the multiples that we have seen, that's something that you will not easily see back, I think. And I'm 2021 and 2022. So that has given a bit the image to the ones that were raising in 2022 and 2023. Like, the ones just the year before us had that, so why not us? And I think that also played a part in why it's diminished. We have seen the last 2 years a lot of internal rounds. That's something we've seen.
Yeah. So that means internal rounds means?
An internal round means that the current investors again participate in the company in equity or via a loan or a convertible loan. But it's typically a more easy negotiation because it's with your current family that you're
trying to bridge to the next big round.
And based on, again, Carta data, they showed that it's picking up again.
Okay. So maybe a little bit of light at the end of the tunnel. So in that respect, I wanted also to ask you, like, how can a startup deal with a difficult funding market? Should they accept lower valuations? Should they accept less tight conditions like the 5 you mentioned, liquidation preferences, whatever? Or should they bridge and hang out until the storm settles down?
You have to be able to do so, eh?
Yeah, you have to be able to do so.
Be able to do so. Yeah.
And if you cannot do so, you accept...
Yeah. I think you, of course, still need to defend your company and fight for it. But it's, as Ruben said, if you're with your back against the wall and it's that or going bankrupt. Yeah, I think, I don't know. We didn't have to face those decisions yet. We were lucky to also have some funding. We acquired some funding for non-dilutive funding, which of course helped us. We didn't need to have the money now, so that of course also gives you a better position. But if you don't have that,
it's sometimes accepting just what's on the table, and you also often don't dare to challenge it because founders are afraid, and we also, as assisting them, that the investors would run away from the table. Because in the end, they're not only investing into your product, but also mainly in the team, in early stage. So
it's a balance. I think on each negotiation point, you have your position, you fight for it, you feel sometimes that at the other side of the table, they also react very emotional or aggressive on it. And then you try to find the middle ground. It really depends on the situation as well, I think.
Okay.
So, and on the people in the deal.
Talking about the people, how do they assess it? Do they ask for where you assessed as a team?
Well, I think they really test you in the beginning.
During the negotiation.
And also in the beginning. I think I don't know which tricks or tests they do, but thinking back, I think in the beginning they feel a bit who you are as a team, how are you working together. I think they do, and I think probably they have specific tricks you might know better.
I think how I have experienced it from Amphistar is that you were a very tight team, a very close team that was very visual, also for me. They've challenged you and you stood your ground on a lot of elements, and even besides that track, you also continued going on all the other tracks, which has the non-dilutive funding has put you in a very comfortable position at a certain point. So all that showed that irrespective of you're going to invest in us, we are going to pursue what we are pursuing, and you want to be with us or not, and that's convinced them more to so a lot of it is also FOMO,
from the investors part.
FOMO from the investors part. At a certain point, especially, I've seen it a couple of times in mainly in B2B SaaS, but there are a lot of, if you have a very good startup with a lot of interests, then you're in a seat. Then you don't have any difficult conversation. It's just calling from the one investor to the other that we have no room enough, and how hard do you want it? And you're the beauty princess of high school, basically, and everybody wants to take you to prom.
Yeah, but beauty princes are not. It's a lot of balls to keep in the air. You have to keep your company running. You have to look for non-dilutive funding because then it gives you an edge. You're stronger in the negotiation. You have to handle all the emotions. You have to handle the whole process with the investors. So it's quite something. Congratulations to you and the team on that. That's really excellent, and congratulations to MACE as well to being able to support the team and
they were
to
fantastic.
be able to close the deal. Super. We were super excited and super happy with that. So I would like to end on a more philosophical note. I would like to talk a little bit about a few minutes about the yin and the yang of governance. You already mentioned you're a founder. You already mentioned that you are a founder-friendly or founder-driven law firm. From my personal perspective, I always think that a company is best managed when there's a good balance between the founders on the one hand and investors on the other hand, because they have a completely different viewpoint. The founders, they are like intrinsically motivated, they are personally involved, they are part of a community, they're part of a team, whereas the investors, they're more rational, they're more financially driven, externally motivated, they're more structured, they look at it as from a portfolio point of view, which is highly skewed towards the winners. But I personally, I think that the best structure is that there's a nice balance between the two, and both of them want to have as much power as possible, and they have very different perspective and very different incentives. So do you agree with that you need this balance, or do you think as a startup that you need to keep as long as possible, as much possible control?
Yeah, so for us it was important in the board to remain at least that we would not be walked over.
Yeah. Okay.
But I agree with you that it's good that it's balanced as well. So I hope let's see, we just closed the round. We're going into a new stage now. We will be at the same side of the table with the investors, and I hope that mostly we will work together and that it will be that their input will also be very valuable. So I agree with you on that point. But I think it is very important to keep as long as possible the right to have vetoes, to really be in charge, or to not have to take whatever decision others will take for you.
Vetoes like what?
Yeah, that you can say at certain points you
like
will
what?
need.
Can you give an example? Well, maybe it's difficult.
Strategy changes.
For example. Yeah.
Long-term perspective.
Strategy.
Yeah. Partnerships.
Yeah, that's quite fundamental.
New equity, new investors.
Yeah, exactly.
New partners.
Who do you let in? But from my point of view, I think there's a lot of focus on and in the investment negotiations on the control, and it's important. For me, there is an economic reality. Which percentage you have, in a way, there is a practice around it that if you have majority of shares, then typically you cannot be overlooked in the board. In early stage, typically the founders are the majority of the equity. Yeah. But from a practical point of view, I think it's very, very rare that you effectively take a decision on a board. So something that I hope that happens in your board meetings, that you have very strong and good challenge moments, but I hope you do not need to look at the vetoes to make a decision.
No, not at the vetoes, but if you have a respectful relationship with different stakeholders. I'm not talking about really the legal, but about listening to each other.
Yeah.
And accepting the other viewpoint, and trying to find a good, coherent solution, because it reflects two different things, and maybe it increases the chance of success. Because if you only look at it from a founder's perspective, maybe you lose a little bit the rational part, and if you only look at the rational financial part, maybe you lose a little bit of the founder's mentality, the founder's perspective. But if you balance both.
I'll give you another example, Peter. We had an example of, so I'm a very outspoken founder lawyer.
Yes, I know.
And there was an investor who put a lot of money on the table, and he didn't ask for a board seat. And there were 3 founders who all had a board seat. And I was the first one who said, why not give him a board seat? You still have a majority, but you have that mirror and that moment where he can challenge you and you can learn from him. So if he would ask for, I would take a different position, but it's completely on the same line. That use also your investors' experience to help you scale and to develop yourself and your company.
No, I wanted to end with that because I think it's important. We talk about the details, we talk about technicalities, about negotiations, contract drafting, but in the end, it has a higher purpose. That is to have a good structure, a good governance of your company, and to have the highest chance of success. And I think it's always in a balance. Great that we agree on that. So thank you very much, Sophie. Thank you, Ruben.
Thanks for having us.
Great
Thanks for having us,
discussion, many practical pieces of advice, and I think it will be very valuable to our listeners. Thanks. Thank you for tuning in for this conversation with Sophie Roelants and Ruben Schoenmaekers. Keep an eye out for our next episode featuring 2 new guests with fresh and inspiring perspectives on startup life. If you want to stay up to date on Biotope's activities, make sure to follow us on LinkedIn or visit our website. If you have feedback on what we've just discussed, or if you have suggestions for new topics or guests, feel free to reach out or leave a comment. Thanks again for joining, and until next time.